Thank you very much, Jeanette. It's a lovely voice to hear first thing in the morning. G'day, everybody. Welcome, and thank you for joining us from all over the world. This is, as Jeanette said, it's one of my favorite topics too, which is market meltdown. We started doing this topic for the first ever time in July of 2015, and if anyone remembers what happened there, that was right as the market took a nice 10% drop, then rallied up, and we had this amazing Christmas rally we were meant to have, markets going to all new highs we were meant to have, and then we had another big nice pullback in the beginning of 2016. The indicators we used we call the top of the market in both these scenarios, and are actually using the same indicators that we started our company with in 2007, when we actually called the top of the market in June 26, 2008. So basically, Acorn is all about using smart money indicators. That's what we base all of our analysis on, and that's why this is such an interesting time, because what the smart money indicators are telling us right now is some signs of real caution, and we're going to get into that. So, of course, there's the standard disclaimer, which, of course, Jeanette's already discussed. But once again on the screen, and we will push forward from here. So, what I'd like to do is to start out today. Let's talk about some market psychology first, and then we're going to start getting into the guts of what's going on the charts and the technicals. If we look at in trading in general, I mean, obviously we're all here to make money, plain and simple, for whatever reason that may be. The reason why most people don't succeed in that journey is because they don't take action. You know, it's the best trade that they've got a watch list, and they've found a trade they like, and they've circled it 5 times, and they've written it down on 3 different pieces of paper, and they still don't end up taking a trade, and 3 weeks later they look back at it and it's up 40%, and you just end up cursing yourself. How many people have done that? I've done that many times. Or simply getting into trades too late and end up losing money from a good trade because of a poor execution, things like that. Anyway, there's lots of different ways we fail because we don't take action, and we asked a lot of our students when they come on board firstly with us. We've done this over thousands of people. What are the main things they're struggling with when they join us? And it's always the same things. It's knowing when to get in and when to take profits, selling too early before a stock takes off, knowing when to limit losses and avoid holding on too long to the downside direction, which overall just comes back to having confidence to execute. And the reason we generally have a lack of confidence in execution is because we don't have rules or systems that we can be confident to follow, or maybe we don't understand them well enough. And that's ultimately what we need if we're going to have, if we're going to try and get that consistency into our trading, which is always the key word people tell us. What are you looking for out of training? Consistency, consistency, consistency. And that's really the thing that we're going to try and help you implement today as a consistent rule system of how to analyze what the market's doing without bringing in all the emotions that can come into play. And that's what we're all about, is systems to allow people and traders and ourselves, it's the same rules we use, to consistently make rule-based decisions instead of emotional ones, and by having these complete A through Z checklists of what is the market telling us. So the big mantra of Acorn is really take risks, take calculated risks, and that's quite different from being rash. The stock market is all about how we manage risk and versus opportunity. And a lot of people, when they look at a market that is as complex as this, and with all the different trends and noise and news coming out, and Trump tweeting and overseas terror attacks, that there's a lot of things for a person to be absorbing on a daily basis, and that can most likely negatively affect our trading decisions. I mentioned at the beginning of the webinar, remember 2015, it's a bit of a horrible picture. Remember that this Christmas rally we were meant to get. What an evil rally that was. Just as it rallied up, hit a bit of a high, and it was basically a perfect opportunity for the smart money to sell off before a major plunge. So all the news luring people in to buy the Christmas rally was where the smart money was selling at their highest, offloading all of their stock to you before the market plunged 10%. So what we want to do is start taking a look at where we are at now, because there are some major threats to this stock market that we can look at from a systems point of view, which I think you'll find very interesting. Obviously, we know about the major problems. Now, these have been here for a while, right? And I think that may be something we can all agree on. Just a quick idea, poll of the audience. Looking at the market right now, obviously we've hit recent record highs on the SPY, the Dow, the NASDAQ. Markets have been at all-time record highs. But how many people would think that this is actually really a market that's never been in better shape than it ever has before, that the world economy is stronger than it ever has been before? Or how many people think that a healthy pullback or possible even crash is something that the market is due for? How many people would think that the market is due for a decent pullback at least? Yeah, exactly. We polled. We did this workshop last weekend to some of our internal people. We had 500 people in the room. We polled everyone. I think 92% agree with everyone saying yes right now. So here's the trick. This has probably been the case for the last 12 months. I've been waiting for a pullback since like a major pullback since the beginning of the year, beginning of last year, because the things that threaten the market are major and they haven't changed. There's still big problems with the Asian economies, big problems in Europe. We've had a lot of interesting correlations with the U.S. dollar and gold movements, which have been. And the way that we've been rallying in both scenarios is reminiscent of markets flocking to safety. And that, of course, means usually happens before a major pullback or correction / crash in the market. Equity redemptions have been at record highs. Throughout the course of this rally that's been building since February, March of last year, there have been record levels of people getting out of stocks. In fact, the largest exodus since 2008 when the market crashed. And of course, these are all big. These are things that we read about in the news, or things we can find out about. But we've been hearing about these types of problems since 2012, when we started trying to print our way out of the problem with quantitative easing. So there's all this news coming at us. But what is the effect when what happens when these problems finally do come to a point where it just starts to drop? Well, the problem is that we have so many problems that all it takes is one major catalyst, like Bear Stearns or Lehman Brothers, one catalyst, one domino to fall, and there is going to be a vacuum where there's nothing really else that the market makers can do here to bring back confidence. They've thrown everything at this. If the big domino starts to fall, there will be a vacuum of buyers and nothing really to hold the market up until it falls to some real support. the things in the economy that then end up happening is you start to see the effect of that from all these highly leveraged companies. It's like, all of the banks that are over leveraged into oil plays with weak oil prices currently, they start to go bust. The oil companies underneath them as a result, but obviously begin by going bust because they can't produce money. I talked to someone last week here in Costa Rica who'd been through that experience in 2007. Was worth over $1.2 billion up in Canada, had 500 employees, the oil price was at $100, lost it all in 6 months, over leveraged into oil prices, oil crashed, and watched it all disappear. And that's a billionaire turned into a millionaire. That's his sob story. Wouldn't it be nice to have that sob story? Anyway, but that's the kind of things you can have. The bottom falls out. The bottom falls out, people then start selling their ETFs. ETFs obviously start liquidating their positions in the market. It's a big domino effect. And as a result of this level of risk that everyone sees, investors and traders just aren't willing to take the types of levels of risk going long right now that the market represents versus the downside level of risk. So, and no wonder why. So as we talk about the bubble effect, or the potential of how much vacuum there could be, there's a great book called Juggling Dynamite by Danielle Parks, which is a really good read if you like looking at things of the smart money nature. But she estimates that there is over $600 trillion of estimated value in worldwide derivatives. And that would be even higher now. If not, I would probably suggest 30% higher. Now, that means what derivatives are, of course, is false value. It's how many bets on the market. Not like owning stock, not owning real value. The derivatives are where we're gambling, betting on what the value of those things will be. So there is a $600 trillion bet existing in the market right now of gambles. Just to give you an idea of how much that equates to, that is more money than all of the real estate in all of the world put together, is how much that number equates to. So as soon as those bets start going bad, you can think of what that equates to. That gives you an idea of how big that bubble is. So, what happens when there's lots of risk in the market? Basically, traders and investors start getting rid of all of the high-risk companies. So stocks in areas that have high price-to-earnings ratios and things like that, where the company is making $1 million a year, but they're charging a price for their shares as if they were making $200 million a year. When that's a 200 to 1 risk-reward ratio. Price-to-earnings ratio. Making $1 million, but pricing the shares at $200 million. So when you start to see companies like that, or even worse, companies that, or better for a short, we should say, companies that are trading and making $1 million but selling at $1 billion, these are the types of companies where people say, yeah, I don't see it, especially not if the market starts to correct. So these are high flyers that we start to look for possible opportunities. So that kind of gives us an idea of what the ideas are for what could bring this market down, or what one of the catalysts could be. But at the end of the day, you don't need me to tell you that. That's in the news. You read that in every single stock report from every single economist warning of a market crash. And opinions, of course, are problematic, because these problems we just discussed have been present this entire time that the market has continued to rally. I mean, what did the news tell us? They said, hey, if Trump gets in, the market is going to crash, right? And it did overnight. And of course, that was where the smart money got out. Kyle Icahn wandered back to his office, covered his $1 billion worth of shorts on the SPY. Why not? The market was already down 1,000 points. So all of the smart money cashed in. They'd made as much as they could in a couple of hours than most people make in a couple of months. And the market went right back up and has continued to go up. So let's ask ourselves some questions that are more that are more based upon systems rather than stories. And that's what we need as traders. We need to maybe we can be aware of the stories like we just discussed, but what's going to actually make us money is how we time those stories, or how we time when the opportunity is now. So let's talk about some of these systems. So the first slide I want to start out with is something we've all heard about. It is the theory of insanity, the idea of doing the same thing over and over and expecting different results. The things that we're seeing at the moment are this equal to, if not worse than, all of the 10% pullbacks we've had in recent times, and very reminiscent of the 2008 setups before the major crash. So we're going to go through and have a look at how we are going to make these decisions and what we look at. The first thing that we're going to look at here is we're going to look at the technicals. Now, technicals, of course, are don't lie. They don't tell us a story that's minced with words and opinions. They tell us where price is going, and of course, the most important information we can glean from a chart when we first look at it is what is the pattern of the stock. What is the pattern? So we're going to go to the S&P 500. And I'm going to pull up a weekly chart for you. All right, so that's the very first thing that we want to look at, is look at what is the pattern happening in the index to tell us where the high probability move should happen. Why is it so valuable? Well, if you look back at 2008, so we can look at why these signals are so similar, you can see on the S&P, I'm going to draw on the support and resistance. And I'm going to so we can get an idea of why this is so, we're in such a potentially big bearish move. Okay. So there we go. We've got the support and resistance coming up on the chart. So in 2008, why did we crash technically? What can we learn from this? Firstly, we had a beautiful upward channel. Now, what is an upward channel as a pattern? Is it bearish or is it bullish? An upward channel is bearish. So in an upward channel, what we should have is one touch, two touch, three touches on the bottom, and then we should break down. That's the rules of an upward channel. And if we're technical traders, we should absolutely be following the rules. Then what happened though? It broke up. And an upward channel should not break up. The only time an upward channel breaks up is if it's gearing into a more bearish pattern. For example, like a head and shoulders or something like that. But essentially, when you get a bearish pattern go the wrong way, it usually means it's pulling back for an even bigger bear move. In 2008, that's exactly what happened. Can everyone see, after we broke out of that upward channel, what pattern did we then form? Excuse me, there we go. What pattern did we then form after that? What was the pattern that then formed after we broke that upward channel? We rallied up, we tested the support on the channel, and then we formed a head and shoulders. There you go, bang. We measure the head and shoulders. Okay. We'll make it a bit bigger there. Okay, we spot the pattern. Now the pattern is going to be the most important thing we start any market analysis out with, because this is where all the smart money's firstly being driven from. As we know, 80 to 95% of the daily volume in the market comes from high-frequency trading. High-frequency trading doesn't care about the news. They care about algorithms. And the algorithms make decisions based on patterns. So that is the most important thing to understand in any trade, because that tells you the rule book. So regardless of the reasons why this market should have crashed or did crash or whatever the case might be, if you didn't know a thing about economics and never picked up a newspaper once, what told you this market was going to crash was that we had the most powerful bearish signal in a bull market, which is a head and shoulder pattern. We measure it, we duplicate it, and that tells us how far the market was going to drop after we created that right shoulder at 1500. So based on a head and shoulder pattern only, you should have been able to predict the market was going to drop from 1500 to 1260. That's a 250-point drop, valuable information to know. What did we then form afterwards? Can everyone see? Another head and shoulder pattern. Okay. So there's your next head and shoulder pattern. Bang. Bang, and because we knew where the first head and shoulders were, that told us where that pattern ended, and that's why we should have been looking immediately for a new pattern as soon as we hit that target. That allows us to more easily identify the second head and shoulders, and then we can again measure the head and shoulders, duplicate beneath. That tells us that the market's going to then drop from 1,300 to 1,000. Again, another 30% drop, valuable information to have. And that is exactly where the support was then created, where we then bounced along beneath. And then actually at the bottom, you may see that there was an inverse or upside down head and shoulder as well. So the reason why I want to quickly show you this is that this period in the market, that if I remember reading the Yahoo Finance news every day and look at, in the newspapers, what was it? Market meltdown, market chaos. No one could have predicted this. This market's impossible to make any money in. Technically speaking, those 2 years were the best years to make money in, but no one was looking for it. We all tend to just get lured in to the Jim Cramer style of news reporting, where of course throughout that whole period they were saying stocks are pulling back to bargain basement levels. October 2007, best time to buy, I think was the news headlines. But no one's looking at the most simplest answer, which was the patterns right in front of us. Let's fast forward now to what's going on now. So the pattern in the S&P 500 has been pushing up beautifully well. Hindsight's 2020. We'll get to that. Because hindsight foresight should be just as powerful in how you go about it. Okay, here we go. So the pattern that we've now been building in has been yet another upward channel. Can everyone see that? I'll make the lines a little bit thicker. For the last 4 years, from late 2011 through to 2015, we had another upward channel. One touch, two touches, three touches. So as I mentioned, the first time that we did this topic of market meltdown was there at the beginning of July, because we'd had 3 touches on an upward channel, which meant from a rule-based system that the market should pull back. We follow our rules and we measure the size of the upward channel. So we go from top to bottom and then duplicate that on the right, and you can see that tells us where the market should drop to. Look at where it dropped to exactly. 2100 straight down to 1863. The low of there was 1867. Again, no news, just purely a decision you can make based on patterns. That's where you cover your shorts and wait for the next pattern then to build. So we look and we wait, and we can see we go up and we go down. You can see that we get the gradient across the top of the candles. That tells us what the pattern essentially is starting to build as. We get another bounce. So immediately now, what do we know this pattern has formed? What's the early parts of that pattern? What do we know about it? We have a downward channel. Okay, so going forward, now we immediately are waiting for this to break out of this trend line, and we go bullish. So there we go. There we go. Right. So we break the downward channel right there. Then we're able to measure the distance from the top of the channel to the bottom. We duplicate that above the breakout zone, and that gives us, sorry, yeah, we're going to make sure we measure it properly. Top of the channel to the bottom of the channel. We measure it, duplicate it above the breakout point, and then that gives us our target on the S&P 500. So then off we go. We're now building, breaking out. Oh, now we've got our new pattern. Now we have another upward channel. So what does that mean? That we're now waiting for the market is now building a bearish pattern in an upward channel way. So we're immediately looking for what's happening next. Okay, confirmed. The pattern's definitely an upward channel. Still looking for our target of 2300 though. And there we go. And that's where we get it. Bang. 2300. Okay. Now at this point, now we're getting close to current day. Now at this point, we're looking at the this pattern where we're bouncing back and forth. But as we come across to the right-hand side of the screen, the beginning of this year, does anyone notice, and this might be a bit more of an advanced question, but I'll throw it out for you then anyway, just so we're all learning together. Does anyone notice any difference in the way that the S&P 500 was moving here compared to the way it was moving previously? Think about the way, the price action, the way that the index is moving. M, you're getting onto it, narrowing range. Lisa, you are bang on. It's before the S&P 500 was oscillating. So instead of saying choppy, oscillating is actually the correct term, because choppy gives you ideas of untradeable, when in fact oscillating is extremely tradable and very profitable, but it's opposite to momentum. Oscillating is when a market does this and goes back and forth between straight lines. That's what makes it move. That's the rules that we follow. We buy there, we sell there. We buy there, we sell there. That's oscillation. It's completely different to momentum, which is where the moving averages, instead of horizontal or straight lines, are what matter most. And that's where the market respects the moving average and breaks through those horizontals, because the moving average is more powerful. And that's what we saw happen in the S&P 500. From this period, the moving averages didn't matter at all. They did not help the stock go up or down. They just followed it around. What made the S&P go up or down was these levels of support and resistance, right? And then all of a sudden on the right-hand side, we start to see the market all of a sudden start respecting it. So in terms of hindsight being 2020, this was where at the beginning of January we said, right, this is a bearish channel, but momentum has taken power, and that means we should probably break higher. Which means we predict for the first half of 2017 a possible head and shoulders to build, and we expect a correction to happen in March or April. You can go back and look at our trading room videos from early January. That was our call on the market, purely based on this, what we're just looking at now. Momentum took control. It broke the bearish pattern to the upside. And as you can see, what we've created possibly here is the beginning of a beautiful head and shoulders pattern again. Can everyone see that? Because that is the definition of a head and shoulders, is an upward channel, well, it can be an upward channel, and then we get the breakdown. All right, well, let's have a look now at what that means. So let's drill down deeper. That means a possible pullback to around this where this support line is rallying up to. Let's now go drill down deep and look at the daily chart. Okay, let's go back to, well, where is the shoulder building? We'll get back to some of these questions at the end. I've got a couple of things to show you here. But real quickly, the right shoulder hasn't formed yet. So this is the left shoulder. There's the head. So we're anticipating rather than reacting. When the right shoulder's already formed, a lot of the easy money's already been made. But that's essentially what we're looking for. A pullback to around 22.50, a rally back up, and then an even bigger pullback. This is a weekly chart, Dwayne. So we're looking at the macros here. All right. Different. Head and shoulder. Yep. Okay. So. This is a leading indicator, because the pattern is one of the few things that tells us what's going to happen next and exactly where that should occur. The next system that we're then going to be able to look at is one called open range. This is the next smart money system. So open range is something that back-tested over the last 5-6 years predicts the market direction to 85-90% average success rate for 2 to 3 weeks ahead of time. This is one of the most powerful systems for predicting market direction in the short term. So we've looked at the big picture. Now let's look at the short-term picture. The way open range works is we look at the first trading day of the month. Okay, so for example, January 3rd. So this alone is one of the most powerful things you can use to in 1 second get an 85% probability of where the market's going to go for the next 3 weeks. That would be worthwhile knowing, right? I mean, we look at all these news announcers that are right maybe 20% of the time. Statistically, they analyze financial advisors on TV and how often they were right. They found that in this YouTube you can watch called The Theory of Experts. 70% of the stock predictions experts made on TV lost money. So when you've got that probability against you, here's something which has a track record of being 80 to 90% correct in calling the market direction. So here we go. High 2263, January 3rd. Low, 2245. So we draw the range on. And as soon as we have the range of that first day, that's the market makers, the smart money, the high-frequency trading talking to each other. That's how the market makers talk. The key support and resistance is set, and then you wait for the market to close above or below. That happens the very next day on January 4th, and that says market will remain with bullish bias. And it will remain that until the next open range day. The next open range day is options expiration Friday, which is the 20th in January. So we go along, open range after a bullish and sideways bias. We then the open range resets. Bang, there's January 20th, high and low. Close within the range the next day, no signal. Close above the range January 24th, bullish signal. Bang. So there you go, you're going long again. Market remains in a bullish bias. We reset February 1st, open range resets. We break above, bang. 1st of February, you're going bullish again. Long, 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 long. All the way up to Friday 17th, open range resets. You're going long again. Long, 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 long. March 1st, open range resets. And I'll report on the March 1st. This is we said beware. The market has created a big rally up on its open range day. This most likely means we'll break down from here, and we did. So this is where we started getting really short on the market. We've been long this entire time since the beginning of the year, since November really, and this was our key turning point where we stopped looking for longs, and we collapsed, broke open range to the downside, and we then set a new one here just a few days ago, or a week ago, on Friday, March 17th. And you can see the system set up right there, and then we close beneath it on Monday. Can everyone see that? So we've got the macro chart giving us a head and shoulder. We've got open range, which is a very high probability indicator telling us to go short. And if you zoom in to some of these shorter term charts, we'll go right down to the hour. On Monday night, and we publish this to YouTube as well, it's there for the world to see. On Monday night, we published that the S&P 500 was in a head and shoulders pattern. That was these are the lines that we drew on here. So my mouse is playing up. There we go. It was in a head and shoulders pattern. So Monday night, the prediction was that Tuesday we would rally and open around 23,750. We suggested a possible play of buying the 238 weekly puts on the SPY. The target that we set on the S&P 500 was 233 to 234. Excuse me, 233.50 to 234 was the target. The weekly options rallied 600% in one day. And this was, again, nothing to do with news, all to do with the fact that open range was negative and we were setting up, and again, a beautiful head and shoulders pattern. So this is what we've looked at what the pattern's telling us. We're looking at what looking at what the open range is telling us. And the open range, by the way, we'll talk more about that in a moment, but that is very, very important. So now let's go on to our next system, What about high yield bonds? What are they doing? So if anyone doesn't know about anything about high yield bonds, I don't blame you. I only started looking at them a few years ago myself. And I don't really care much about bonds. I don't trade bonds. I don't follow bonds. This is what I like to look at. I like to look at bonds to tell me where the market's going. High yield bonds is essentially what the big smart money boys and girls buy if they believe in corporate America. If they have confidence in the stock market, they will buy riskier bonds that back corporations. So if you believe, hey, companies are going to have no problems paying their debts, they're going to continue rallying, then smart money buys these things. If they do not believe in the health of the market, these things go down. What's been happening, and in fact this has been happening since we started printing money in 2012, the market has continued going up. High yield bonds have crashed. Typically, once upon a time, high yield bonds did exactly what the stock market did. In fact, high yield bonds and the S&P 500 matched each other perfectly. They stopped moving together when quantitative easing kept printing money. So in the short term, though, what's very interesting to look at is that while the market had continued to go up, since mid-February, high yield bonds have also been plunging, which is a divergence which has almost always resulted in a minimum of a 10% pullback in the stock market. Corporate, once they break 86, should have another drop down to as low as 84.60. So we're definitely in this kind of bearish pattern, as you can see, on the corporate high yield bonds as well. So the smart money does not like risk in the market. And this chart is HYG is the ticker symbol. All right. And I want to show you one more smart money indicator. So we've looked at the pattern. That's the most important. We've looked at open range. That's the highest probability indicator. We've looked at high yield bonds. Everything so far is saying bearish. Let's look now at one thing that you may never have heard of before, which is MMFI, which is actually stocks above or below their 50-day moving average. So this chart is actually the amount of stocks, the percentage of stocks that are in the S&P 500 that are actually above or below their moving average, their 50-day moving average. Why is this so important? Because smart money buys and sells at the 50-day moving average. It's an institutional level where for longer-term support, if the big money believes in something, when it pulls back to the moving average, they buy. If they've lost faith in it, they don't. In fact, and then if it breaks below, they might even liquidate their position. So it's a quick key indicator to look at where smart money is going by simply saying, okay, if the market's going up, the S&P is going up, the Dow's going up, are the stocks inside it actually doing the same? Now have a look at the pattern here. On January 5th, 79% of stocks were above their 50-day moving average. Since January 5th, the market continued up to make record highs. But since January 5th, the amount of stocks above or below their 50-day moving average has dropped from almost 80% to 43.52%. 43.5%. That is a huge drop. And even more powerful, this indicator has been correct. I think it's between 80 and 90% of the time it has diverged like this. It has resulted in a minimum of a 10% pullback in the S&P 500. Again, look at the chart here. (2015) in November, market was rallying. Look at what the high yield, look at this, what the indicator did, straight down. I mentioned that July 2015 was the first time we did this webinar. Look again at what the signal was from April. Market didn't crash till September, was when it started to crash. Stocks were already down at 10 to 25% declines, or under their 50-day, So this is another key smart money indicator that is giving us a very bearish sign that is also has an incredible track record of being right. And let's look at one last thing. What is actually the smart money? Let's go directly to the smart money. Let's go directly to the people that are actually behind the market. The insiders. This is the buy to sell ratio of insider buying versus selling in the market right now. Can anyone see the trend? So does this look like that the people that run the companies that we're investing in, not just the companies, but the biggest ones, Apple, Google, Amazon, Salesforce, all these different companies, these big boys, these titans, the CEOs, the executive vice presidents, the chairmen of the board are all selling. And we're dealing with massive multiples. In fact, that's the ratio of insider selling versus buying in the market over the last 12 months. The red is the selling line, the blue is the buying line. Once again, do you notice the trend? Since the beginning of the year especially, as stocks have been dropping from 80% above their 50-day moving average to 43%, look at the ways that the insider selling versus buying has dramatically moved apart. Okay, so what does this mean? This means that this is now time to start being cautious, at the very least. If we break down much below the current support level of the S&P 500, if we break below the low of this candle, and we already made a new low on Friday, open range is still negative and will remain negative until the end of next week when the month finishes. Oops, sorry, I may have deleted that, but if we break below the low we set on Friday, watch out. That could be an easy drop down to 2260 at the least. So we are at a test point. As traders, we can see where money's going. It's a matter of timing when it's right to act. We believe we're already there, at least to start looking for really high quality shorts. And so what we're starting to do is reinforce the battlements to start looking for the best potential opportunities. Now, so in these times, it doesn't mean you stop going long, but it just means you start looking for only the highest probability longs and the highest probability shorts, the ones with the strongest patterns, and that's what we've put on a very special workshop. We've only hosted this course 3 times previously in Acorn's history, and the workshop is called The Big One. And the big one is all about scanning for these opportunities. So the things that we're going to be looking for in this workshop, we're showing you how to look for, is how to start scanning through all this noise and garbage for where the most interesting setups will be. And the idea is to be efficient, because if we're going to try and find the stocks that are going to be the strongest opportunities for longs and shorts, we need to really look for the perfect storm. And this is what this is all about. So the big one is 2 on-demand lessons that we just recorded this week, followed up with our special live lesson coming here at March 24th. So over the course of these 2 modules and the live lesson, what we're going to be teaching you is a start through finish way to go through all of the I apologize. Sorry, yes, it's April 1st. I apologize there. April 1st. So what we're going to be going through is going through all of the systems that we've just gone through in depth. So firstly, we teach you how open range works. Open range is so valuable. We give you there's a 30-40 minute lesson on open range on its own, which goes back through the 5 years of back testing, how to use it, how many points above or below the range does it need to break, all of that kind of key information. We also talk about how it applies to day trading, how it applies to other indexes and stocks. That alone is something that I don't think any trader should be trading without, given the success rate. We go through how to locate where the smart money is going in seconds. So we teach you how to be able to find exactly, for example, where the most weakest sectors and industries are in the market with one click of a button. So you can see where we may want to start focusing on looking for stocks. After we've given you all the theory, the knowledge of how we are, or what types of smart money systems we use and how we use them and their success rate, we then go in to teach you how to scan for it. The big one scan is incredibly powerful. It is where we are looking for stocks that have, price to earnings ratios of, it's like 1,000, 300, 200. We're looking for stocks that have huge P/E ratios as well as all of the insiders selling. We look for stocks that have the institutions selling. Not just one insider, but the vice president, the chairman and CEO, the directors, the chief compliance officer, and they're liquidating 50% of what they own in the stock. That's one of the things we scan for as well. We also look for the fact that they've got way more debt than capital. We look for the fact they've got no cash flow. And to couple that, we then add the highest probability patterns on top of that, all into one powerful scan that looks for the perfect storms. And where we have these 20 to 50% potential declines, which of course in options is huge if you add an option to that. And then what we do for you is we also then put this into our custom-built, this spreadsheet is built purely for this workshop, but you can, of course, use it for your other trading. I'm just going to hide the stock symbols, but this is then the worksheet you also will get to run. So these are actually our favorite big one plays that we have already now researched, because the market may not wait till the end of the week to start setting up with some awesome trading opportunities. We already have 1, 2, 3, 4 that have triggered here. But as you can see, this spreadsheet will automatically populate with the price to earnings, how much cash flow they actually have versus their price. Anything above 50 is considered bad. And this is where you can start getting some of these opportunities. And this will give you all of the entry signals and exit signals on all of the alerts that we give you, right down to the risk-reward ratio at the end. Obviously, higher the better. And this is one of the ones right here. Entry was $54, target $44, stop loss $55.13, 8.85 risk-reward, and 44% insider trading. That stock was PTC. I think I'm just actually out of time in a second here, just looking at the clock. But just to give you an idea, this is the kind of things that we will help you find. Yes, the spreadsheet is part of the big one. So when you enroll today, what you'll receive is the first 2 lessons right away. As well, you will receive all of the a video of all of the current alerts, entry signals, exit signals, a breakdown of why we like them, why we like the favorites so much, the story behind them, what the insiders are doing. So you'll be having actionable trade ideas right now. Something you can look at over the weekend and be prepared for Monday, especially if this market breaks. You don't want to wait for next Friday to start looking at this, because if we break on Monday, you could miss some really big moves in these stocks. So there you go. So you can enroll at acornwealthcorp.com/smart. And just to give you an idea, that worksheet, we analyzed manually over 600 different stocks that had the highest amount of insider selling in the market. Then we applied our scans, and then we individually went through every single one on top of the scans that we did. So there's probably about 100+ hours of research we did over last weekend and into Monday to come up with a list that you'll receive today. Yes, we'll send you the recording if for any reason you're unable to attend live. But just going through these 2 lessons over the weekend and this spreadsheet will completely prepare you for Monday, because we do go through the scan in the recording. We do go through all of the trade setups in the recording. We go through all of the smart money setups in the recording. Everything on the screen here, you will be able to watch this weekend. And then in the live lesson, we're just going to be applying it to the updated market conditions as a open range resets for the beginning of the month. How do you take the course? Just go to acornwealthcorp.com/smart. I promise you will not be disappointed. This is one of our most popular courses, and given the market conditions, this is for $97. If you think about how much opportunity could potentially be here just by being to sniff out some of these types of setups, I mean, they're awesome. I'll show you one last one. This is another one from our scan. Jeanette, just let me know when we've got to finish up here.
John, go ahead. We started at about 8 after, so you got about 3 minutes.
Perfect. Okay. Look, this is another example of a beautiful setup that we found. Now, again, I don't want to confuse people. The entire course that I've shown you here, you will receive now. You will get the entire course, so you'll be able to go through the scan, the setups, everything. The purpose of the live lesson is we're then going to have a practical session where we repeat the application of the scans and going through them and looking for new setups. The system success rate is very high, and so because I'll show you some of the stats if we get time here in a second. The beauty of what we're doing here is we're searching for the perfect storm. So we're looking for stocks that even if the market went up another 5%, even if, this would still have a high probability of dropping. If you look at something like MELI, now this is the Spanish version of eBay. have a look at what this is setting up in. This is setting up as a beautiful head and shoulder pattern, right? And if you actually have a look at the insiders, what you'll see if you have a look at the insiders, what you'll see, if I can get my my list up here, here we go. Go to the insiders, and you'll see that eBay, that was one of their 10% owners, just sold $1.2 billion worth of their position, reducing their position by 87%. So eBay, the people you think would know the most about this type of industry, the 10% owners behind the stock, just liquidated almost everything they own, going into one of the worst market conditions we've seen in a decade, setting up in one of the most powerful patterns that you can to short. And we're waiting for the entry signal because we want to get confirmation. But I mean, something like this, you've got a downside from 210 to as much as $80. Think about what a 220, think about what a 190 August put would be worth if this got down to $80. This is the kind of thing we're looking for, and we have a spreadsheet full of these ideas that'll let you know exactly when they become ready. But that is just one of the setups that we're looking at. And yes, I'll leave the link on the screen here for you. One more example. I'll show you HQY. HQY was one of our alerts at the beginning of the week. In fact, I'll just there you go, HQY. This one, I'll just pull my spreadsheet over here and tell you what the stats were. But this was another one. Look at that. You got a perfect head and shoulders pattern. So even though the market hadn't broken net yet, this was a high quality trade setup. They had a 102 price to earnings ratio. Their price versus their cash flow was 130 times it. That's huge. 91% of their insiders selling in the last 3 months. These are all stats you get on the spreadsheet. This was a setup for an excellent possible entry up around 45. And again, look at the target. You got a beautiful setup from 45 down to 34, so you got $11 of reward for a stop loss just above 47. $2 of risk for $11 of reward. Excellent option set, potential there as well.
Johnny, we're right at game time here, but I see this question getting asked over and over, so I want you to address it before we go to the next speaker. They're asking what software they have to do these scans, and I don't know if you covered that, and is it a one-time fee? Those are the two.
Yeah, it is absolutely a one-time fee. The scans and indicators we use, we programmed into TOS, so Thinkorswim, TradeStation, TC2000, Metastock, Incredible Charts, and the scans that we'll be teaching you on are also able to be run on a free online tool that we will take you to, and then we run the scan and we export the results straight into our Excel. So even if you don't have any software, you do not need anything to do this course. We use free tools and we give you all of the applications, all of the algorithms and everything for you, and all of the indicators are also are also pre-programmed into all the major software systems as well. So that's what you're getting for the one-time fee, and you're looking at about 4 hours of on-demand material, and the class on Friday will be a 1-hour live application looking for the top setups for next week. What you'll get today is the top setups for this week. I hope that answers those questions. So, okay, well, thank you, everybody, for a wonderful session. I mean, look, we could be wrong. I don't think we will. But, again, this is going to prepare you for how to start protect against risk and look for some of the best opportunities on the downside. So I hope you'll join us. And if you have any questions, feel free to forward those through to us.